Good morning, everybody. Welcome to our program, Long-Term Care, the Elephant in the Room for Retirement and Legacy Planning, which is being brought to you by UB's Office of Gift Planning. My name is Wendy Irving, and I serve as Assistant Vice President for Gift Planning at the University of Buffalo. This morning, I'm pleased to welcome Jim, and Michael Turpak, both graduates of UB.
Yeah.
Thank you. Who will share a wealth of knowledge about long-term planning. Jim Turpak is president of Turpak Financial Advisors, a wealth preservation and business continuity firm. Jim earned his undergraduate degree from the UB in 1978, majoring in psychology, and also holds a master's degree from Purdue University. Jim is very active in our Western New York community, currently serving as serving as president of the Rotary Club of Buffalo. Jim has presented on this topic for us in the past, and we've invited him back because he's so popular, and I think you're going to learn a lot this morning. In this area, he's regarded as the go-to gentleman on the topic of long-term care. Turpak Financial Associates traces its roots back to 1933 through 3 generations of non-family ownership. Now, Turpak Financial is planning its 4th generation as Mike Turpak prepares to continue that legacy. Mike earned his bachelor's degree from UB's College of Arts and Sciences in 2006. Mike specializes in personal and business planning strategies. Like his dad, Mike is also active in the community, serving as president of the Rotary Club of Amherst and heads up the Buffalo chapter of the Society of Financial Services Professionals, Young Professionals Committee. Please join me in welcoming Jim and Mike. Thank you.
Thank you very much, Wendy. And since we were promoting the university, I'd like to say thank you to the university for having us here. Thank you, Wendy and Neil and everyone else who helped put this on. We actually, to confess everything, and it's usually not a good thing to do in front of development people, but I will do anyway. Between Mike and the rest of my family, we have 5 degrees from the University of Buffalo. And if we bring in Mike's wife, we actually have 6 degrees from the University of Buffalo across 5 people. So with that, I'd like to today, though, talk about a very important part and that topic, and that is the elephant in the room, and that is regarding financial planning. Hopefully that got your attention. The elephant in the room is, if you haven't discovered, is something called long-term care. Let's start with a show of hands from individuals who have had a family or friend needing long-term care. Show of hands. Okay. I just use that as by way of background. I've actually been instructing or presenting in long-term care for a little over 25 years. And to give you a perspective, when I first asked that question, 1992, what the answer was roughly 20 to 25% of the audience would raise their hands. And if you looked around today, it's usually in the neighborhood of about 75% of the audience, closer to 80. And the reason why is we'll get through some of the data today is that we're living longer. That's both good news and that's bad news. It's great news because we've got a lot more time to enjoy ourselves, but it's not so good news in the fact that many of us have been raised in a model with expectations of a life expectancy of age 74. That's what it was when we were born. Anyone want to conjecture what our life expectancy, if you have 2 65-year-olds, you got a couple retiring today, what's the life expectancy of the survivor of 2 65-year-olds? Anyone? We hear 87. Somebody has the right answer. It's 92, okay? That means, just for those of you who didn't take statistics, I took the class at the university. I took statistics. I'm not saying what I got for a grade, but I did take it. That means half of the survivors will make it to age 92. And half will go beyond the age of 92. By the way, that statistic is from the year 2007. So I'm guessing when the next statistic comes out, that might be nudging in the direction of being older. I go through that exercise many times with my clients, and I like to do it with an audience because we have to prepare to be here a lot longer than we originally thought. And that changes our whole way of thinking about things, because it's important that we understand that we have a lot of things that we're going to have to be doing in the future. when we get into planning, there's going to be several things that we're going to be do. We're going to be looking to, hopefully, if I can do this right, fund your retirement. Now we just mentioned what retirement means. It's going to be a period of time that's going to last much longer than we originally thought. With that, we've got to look at a lot of things that we probably will want to do. We could fund something like life and health insurance, which is probably something that we're going to want to do in retirement. We're going to potentially leave something to our heirs. Many people feel that's an important thing. Or even if it's not the most important thing they're looking to in their plan, they'd like to say, if there's something left, I'd ideally like to have something there. And of course, no presentation here at the university would be appropriate without saying, also, you might want to give something to charity. And with those potential goals, what we have to do is recognize that in order to do something about that, we have an elephant in the room. And that elephant in the room, as I mentioned earlier, is the cost of long-term care. Let's talk a little bit about that. Hopefully. What is the cost of long-term care? Oh, we'll go back. First of all, let's talk about probabilities. This is an interesting one. The statistics on this, back when I started back in the early 90s in this area, is if you had two 65-year-olds, the probability of one of them needing long-term care was 70%. A 70% chance that one of two 65-year-olds. Today, that statistic is the probability of one 65-year-old needing long-term care is 70%. So we've increased the probability of need significantly over what it had been many years ago. And as we age, that increases as time goes by. So the magnitude of this problem is very significant. What we look at in terms of what's going to take place for individuals, by the way, an important thing, as we were putting this presentation together over the last couple of months, what you will find very interesting is that many companies have recognized the fact that there is a big breakdown in the average length of stay of a nursing home. Before we get there, we're going to talk about some of the issues. The sandwich generation, as we talk about, is those of us who now prepare not only for the need of their children's, but also their parents, and believe it or not, their grandchildren. I call it the triple decker. In my own very office, I have someone who is taking care of both her mother-in-law, her mother, doesn't take care of her children at this point in time, but is actually taking care of those grandchildren a couple of days a week. That's what's happening in the sandwich generation. The amount of the sandwich is getting bigger and bigger. The probability of us taking care of other people is increasing as time goes by. What that means is that 1 in 4 adults today is an unpaid caregiver, and you have a better than 1 in 3 chance that those caregivers are going to quit their jobs at some point in time or change their hours dramatically to take care of somebody else's needs. So with that, what we'd like to do is then talk about what it costs today for long-term care. And with that, I'll switch over to Mike. Mike.
Perfect. So today, in 2012, the national average was 90,520. Does anybody want to take a guess as to what New York State's average? I'm guessing you can all guess it's higher. What's that? You're pretty close. It's 122. You're very close. And how about Western New York? We have 116,577. So we're a little bit below the state average. That is because that includes the outlying counties of greater Western New York. And if we look at the quality, and we define that, we did a survey of a few of the Weinberg campus and a couple of the others, about 124,100. So just under $125,000 is going to be the cost of a long-term care stay at one of these quality nursing homes in Western New York. That's just per year. So we look at, the biggest question is, how long do you stay at the Hyatt when you're on vacation? Maybe you stay 7 days, 10 days, 14 days, maybe you go a month, but in Buffalo, long-term care costs over $300 a day, which is more than the Hyatt costs here. It's more than the mansion on Delaware costs. So what is the real reason you don't stay longer at the Hyatt? because it costs so much. And so to suggest that we can spend over $300 a day out of pocket at a long-term care, which probably even the nicest ones we studied probably aren't as nice as the Hyatt or certainly not the Mansion on Delaware, gets to the biggest question. So what is the average length of stay in a facility? Does anybody want to take any stabs at that? And these are new data, because even when we started working on this presentation, some newer data came out. Does anybody want to take a stab at that? 3 years. That's a pretty good one. Now they started breaking down male, female, because what we learned was 2.8 is your average, so you're very close. 2.2 for males, which I guess is good, because you don't want to be in a facility that long. And unfortunately, 3.7 years for females. So that actually has recently changed and is recently reflected in some of the pricing of some of the models out there. Whereas prior to extremely recently, the past year or so, we didn't keep as tight a statistic on the gap between males and females. But that is a substantial gap in years, and therefore a substantial gap in pricing. So, will this problem go away? I'll turn that over to you.
Probably one of the most important things to recognize in dealing with this problem is obviously it's huge. If we're talking about more than it costs to stay in the nicest hotel in town to go to a place that's not as nice, the really big issue here is the cost of inflation and the impact that it has. And inflation's a word that's bandied around, and if you're doing economic models, maybe you understand what it means, but what it really says is the rate at which something costs more in the future than today. And what is costing more is that senior care, and specifically senior health care, is still going up at a much more rapid rate than regular inflation. And that has been true for over 25 years. Senior health care costs have been going up at a much more rapid rate. What that means, for those who haven't taken math deeply, is that it's going to be way more expensive for you to provide for long-term care in the future than it will be today. If we're talking about a need, we're talking here today, regular inflation is 2 to 3%. By the way, that's really a push. It's barely 2. It doesn't sound like a lot to have the difference between 3% and 4%, and I'm not sure who's doing that.
I did, sorry.
Okay. But what the difference means to people is that you're getting into a cost that's significant, and it's not going to go away. The magnitude of it is such that if today we're going to spend roughly $125,000, just to make my math easy, if you were needing care locally, what we would do is in just 12 years, that would be $250,000 if we're talking about a 6% inflation rate. And in 24 years, that would be an amount of approximately $500,000 per year. And that sounds like a lot of money, and you're saying, Jim, you're crazy. There's no way that the cost of long-term care is going to be $500,000 a year 24 years from now. So if I'm 60 years old, when I'm 84, that's probably when I'm going to need it. You're going to tell me I'm going to pay $500,000 for my long-term care. Ain't going to happen. I'll tell you that it likely is. And why is it likely to be the case? I have notes from a presentation I did in the year 1992. And the cost for long-term care, anyone want to guess what that was? I don't know what it is daily. I know what it was annually. It's $20,000. Okay? 20,000 in 1992, 125 today. Think about the multiple. Now, the interesting thing and why this is very important for us to recognize for our own personal planning is that the magnitude of this issue is that the baby boomers haven't hit the marketplace yet. Let me repeat that. The baby boomers have not hit the marketplace yet. Yes, they may be buying long-term care insurance policies, some of them, but they haven't gone to facilities yet. And if you understand, if you didn't go to economics or understand any of that, those facts, is when demand goes up, baby boomers going to the market, what happens to price? Price goes up. More people want it, the more it costs. So the importance of this is that this was not an issue that will go away easily. So we need to be very aware of the fact that this is not something to be taken very lightly. I use this as an example. how can you deal with a third of a million? By that way, that would be the average between males and females today, of $1 million problem that's growing at a rate faster than inflation is. And how do we deal with the problem then? First thing we take a look at, hint, we can go to the government, or so we think. And for some people, we can. There's Medicare, and what it'll provide for you is some very limited level of coverage within your health insurance policy or Medicare policy that'll usually cover up to 20 days of skilled nursing care. Then I use the term skilled nursing care. Not a lot of people need skilled nursing care. Less than 2%, actually typically less than 1% will ever need skilled care. But that's what it'll cover, roughly 20 days. That's not really a long-term care stay. That's needing health care for an abbreviated period. The next thing is Medicaid. Okay. And what we have is, in Medicaid, we have assets. Medicaid is really the health care system for those who have depleted assets. And I use these numbers. I apologize if they're off slightly. Most of these numbers are changing every year. I think I got them right. This year's, I believe, if you're married, you have $117,240 is the amount of assets maintainable if you have a community spouse. And a community spouse means somebody who's living in the community. It says if it's married, but that's not 100% accurate. If you're both in the facility, you don't have this luxury. If it's $14,550 worth of assets are able to be maintained to qualify for Medicaid. If you've got more than that, you have to spend it for Medicaid to cover you in an institution. Your maximum monthly income, $29.31. That's, again, if you have a community spouse. If you do not have that luxury, you can have $50 plus the cost of the premium for health insurance to provide care. Self-insurance. My son Micah knows that this is not my favorite term. Self-insurance, as I always say, is the way that you can pretend that you're handling the problem when you're not. As I outlined earlier, the magnitude of this is significant. And self-insurance is the belief that you can come up with $124,000 out of pocket, growing at 6 to 8% per year. The reality is, I've used an example here of buying, and I apologize, it's not in your handouts, this was a last-minute ad. What this has is if you took $1,700 and bought a partnership policy, which you could do if you were 50 years old, and instead put that in the investment. If you put it in an investment and you did that over a period of 20 years, that's the little blue chart as to how much your investment would be valued at if it grew at 3.5%. You'd have $49,800. The policy that you would buy in a partnership would be valued at $393,000. So for providing for long-term care, putting the money into an investment in hoping self-insurance will work, the math usually doesn't work out real well. Now, obviously, if you made a higher return than 3.5%, you'd get a higher result, but you're not going to approach anywhere near the magnitude of what the contract would do for you with the insurance policy. Long-term care insurance. Use the leverage of premiums to provide care when you need it. The good news about a long-term care policy is that it can provide what it is that you need when you need it, and it does so on a leveraged basis. What you're looking for in a policy is for it to be able to provide for you when one of these things occurs. This is actually the IRS's definition of what you need to trigger a claim under a long-term care policy, and that is inability to do 2 of 6 activities of daily living, or you have a severe cognitive impairment. Here are the 6 activities of daily living: eating, bathing, toileting, transferring, continence, and mobility. If you can't do 2 of those things, you will usually be able to have a long-term care policy pay for you. Okay. Ways that you can ensure long-term care needs: a traditional policy. I'm going to skip through that and come back. New York State partnership and hybrid policies. A traditional policy would be one that is not a New York State partnership policy. That's probably the best way to define it. And what is a New York State policy? partnership policy is one that's been approved by the state, that has a separate contract from the insurance policy itself. It says when the policy is exhausted by utilization of benefits, that you will then be able to have eligibility for Medicaid and still maintain your assets. Let me explain that in English. That means if you buy one of these policies from an approved insurance company and it's done paying its benefit, you get to qualify for Medicaid and you can hold on to whatever you have. And to quote, yes, I'm saying Mario Cuomo, not Andrew Cuomo, because when the partnership came out, it was actually Mario Cuomo who was governor at the time. You can have $1 billion of assets and still qualify for the partnership. Why it's an attractive solution today is when this first came out, there were really only a handful of states that had this. And you had to stay in New York or be in New York in order to qualify for this. Over the years, what's happened is most states now have reciprocity. So if you buy a policy in the state of New York and you move to Pennsylvania or Florida and you go on a claim and you want to file for the Medicaid portion, those states will recognize that you've qualified for the partnership feature and will allow you to qualify for Medicaid. Still maintain your assets. And by the way, very importantly, will not come against your estate. So not only can you hold on to them, but so can your estate hold on to those assets. So that's why the partnership is very attractive. Let's talk, though, in general about the partnership, or about a long-term care policy before we go into the detail on partnership. There are many features that are moving parts in a long-term care contract. Waiting or elimination period, depending on the company's language. Inflation features, whether they're indemnity or reimbursement, benefit amount, benefit length, shared care option, care management. Now, I've got a lot of faces from the audience asking me, what does all this stuff mean? First of all, here, waiting or elimination period. That's the period of time in which a benefit is not being paid, that you are eligible for care. You've met those 2 of 6 activities of daily living or severe cognitive impairment, and now you're in a position of needing care. The waiting or elimination period on most policies today will be 30, 90. Sometimes you can find the longer waiting periods, but generally most contracts are in the 30 to 90-day period. The inflation feature, as I mentioned earlier, is a huge, important part of pricing out a policy. If you are eligible for long-term care insurance today, I'm going to suggest to you that you're not likely to be a claim soon, because insurance companies will ask health questions. And if you're healthy enough today, they're probably saying that you're not highly probable to have a claim. The reason why that's important is the inflation feature becomes more and more important the longer out you are before you're going to need the money. And as I mentioned earlier, the magnitude of that growth is significant. So an inflation feature is very important. Various companies will have various ways of dealing with that pricing. Indemnity or reimbursement really isn't that important to know, other than one form is, namely the indemnity is pay you a check. The second one is it reimburses whoever provided care for you. And we'll get into that in a little more detail in one of the other options. Benefit options, amount, benefit length. Needless to say, the longer you want coverage, or the more of it you want, the more expensive it is. So in designing what it is that you'd like to do, you want to outline what's important to you, where do you see the risk, how does it integrate with the rest of your assets. And it's important in doing this that you go through a process of looking at all of your assets, not this concept in a vacuum, because you want to see how that'll integrate with everything else. Shared care option, one of the features that you can find in some policies is the ability of spouses to share a benefit. So if I buy a policy on myself with a 4-year benefit, and my wife buys a policy on herself with a 4-year benefit, and I exhaust my 4-year benefit, I can tap into her policy for a few more years, utilizing her benefit. That obviously would reduce her ability to collect on it if that occurred, but that's what the shared care option is. It's Obviously, that's a rider that will cost more money, but it helps provide a longer-term benefit if that's a concern. Care management, most long-term care policies today have this feature. Most of them, interestingly, do not charge for this, but it's important to make sure it's in there. It wasn't that prevalent in the marketplace years ago, but it has become one feature, and what it does is it says, if I have a claim, I've never experienced this before in my life. I've had family members or friends experience, but that was a lot of years ago. I don't remember what it is that they did. What care management says is we will provide people with skills that know how to put you through the system to get the best care for the person who's needing the claim that's available in your specific geography. So here in Western New York, they'll tell you these are the places you can go. This is where you can get good assisted living. This is where you can get good home care. These are people that we have experience with on filing claims. That's what the care management feature is. Items affecting long-term care policies. Other items, I mentioned the waiting period. Oftentimes people have looked at, for example, their disability insurance policies, and the general rule of thumb there is go with a longer waiting period because it saves you a pretty good amount of premium, and you hopefully have some money in a savings account to help offset the difference between, for example, a 30-day and a 90-day elimination period. EP, by the way, stands for elimination period. Apologize for the little bit of.
Different from the slides to change age and the new product.
Okay, thank you. Yeah, this is slightly different. Mike, very important point. The products have changed dramatically. They continue to change. The slide you're looking at is going to be slightly off from this. This reflects the new latest, greatest pricing up here on the slide. Changed it within the last week. What we're saying is the difference between a 30-day elimination period and a 90-day elimination period appears to be roughly $830. Actually, I don't think we did our math right. That's part of not corrected. Yours will say 736. It's actually about. That amount of money paid over even a 20-year period of time would be about $16,000. Sounds like a lot of money for you to save. But if you take the benefit, which is, in this case, $300 a day, and you provided 60 days of benefit, that's $18,000. Doesn't sound like a lot of savings, $16,000 versus $18,000. But the thing that's missing is this pricing reflected inflation on the policy. So the benefit that appears to be $300 today is actually significantly higher when you go to the claim. So in my example of 20 years out, we could have a benefit that has now gone from $300. It would be in 20 years well over doubled, so we'd have about $750 a day. And when I multiply that out times 60 days, that's to the tune of roughly $45,000. And I've paid $16,000 for that extra benefit. So when looking at a waiting period, you have to think that through. Do I have the wherewithal with other assets to make that gap between that $16,000 and $45,000? So it's not an easy answer. In a lot of things that appear to be an easy answer, they are not always there. So very important. We're covering a lot of general topics today. Specifically for you, it may be different. So I apologize to you if we've covered a lot of things in different areas that may not be true. Coming back to inflation, that was just what I did in advance. Okay. Yeah, what I'd like to do then is switch back over to Mike, who'll cover a little bit on the New York State Partnership and what it has to offer you. Go ahead, Mike.
So as we mentioned, there's really 3 insurance ways to protect yourself. The first being traditional long-term care. Second being New York State Partnership, which is a kind of a blend between traditional long-term care and Medicaid qualification. And then the third we'll touch on. As far as New York State Partnership is concerned, buying a policy today, the minimum daily benefit you can buy is $274. And the minimum coverage length is 2 years. Now that would be what's called their Asset Protection 50. It was what, when we went back a bunch of slides, it was what the charts were based on, where that $1,700 came in. That was actually the absolute bare bones stripped down contract on a 50-year-old for this partnership illustration. you can go dial that on up, but as long as the policy meets those general specs, and they are changing, again, they changed from the booklet that's screenshotted here versus the booklet that we have some to hand out at the end, because it does change that frequently. As long as you meet those minimum specs with an approved insurance carrier, which unfortunately that pool is shrinking. There are still a couple, but not too many anymore. And the policy has that logo on the deck page, then you would qualify for that protection that Jim had mentioned earlier, which was once you drain through the assets, whatever you have purchased in terms of protection, which can be 100%, it can be 50%, or it can be dollar for dollar, and I think we go into that here, you will now have that protected from Medicaid. So if you do what's called the TA 100, Total Asset 100, that will allow you that $1 billion that Mario Cuomo mentioned, or $10 billion or $100 billion of protection, should you have that wherewithal. But anything over that. There are other options, obviously, if you're not looking to protect $1 billion, as our former governor's example was, you can purchase dollar for dollar protection, or you can purchase different levels of total asset protection. So you could protect 50% of your assets, that's an option, or you can purchase a dollar for dollar protection. That is something that impacts the pricing. It is one of the reasons why you may consider more than one of the solutions we outlined, or along with, again, depending on everyone's individual situation, the assets you have outside may cover some of that waiting or elimination period, or some of the other solutions may cover that as well. Yep. Oh, yes. Before we get into hybrid life insurance and annuities, because that's kind of an interesting and different and definitely a good gifting method, we want to see if anybody had any questions on the long-term care traditional and partnership policies before we move on. Yes?
Why did you indicate that it's dwindling in terms of the number of insurance companies offering the
Sure.
partnership plan?
No, it's not New York or the partnership that's the issue, it's claims exposure is the simple answer to your question. The question was, I'll repeat to the back of the room, why is the number of insurance carriers dwindling? Because of insurance companies look at their claims exposure and they say, we have to continue to pay these claims. So a couple of years ago, one of the examples was MetLife, Metropolitan Life. They're a huge insurance company across all fields. They looked at their book of business and they had a lot of claims that they wanted to continue to pay, so they didn't want to continue to be in the long-term care space so that they could fulfill their current obligations. They didn't want to take on new risk. So as these insurance carriers look at the space, they look at the new numbers, and you saw how fast the numbers changed, such that the numbers that reflected there and why they're different than your slides is Genworth Life, if you looked at the little footnote, did in fact change their numbers a week and a half ago. And we had to have this filed to our brokerage or our oversight people prior to that to come present this to you and then be recorded. So the numbers do change that quickly. The one thing that we didn't mention, but was one of the bullet points on the card that we mentioned, is when is the best time to buy? And the answer is yesterday. And that's just because that is the availability and change in the long-term care space. Did you? Yeah.
If I may add a couple of things. That marketplace has changed dramatically. The main carriers that existed 25 years ago were companies like Travelers and CNA and Met. And today, there are companies like Genworth and John Hancock, who has been around throughout the process. So there are a limited number of companies selling product, both for partnership and traditional. We're down to probably roughly a dozen. And probably 20 years ago, there were probably 40. So that's the nature of the beast. Yes, other questions?
20, 30 years down, if one were to need it, what if some of these companies are out of business? Does New York State, because it's a partnership policy, cover it
Okay.
or back it up?
All right, if I may paraphrase the question is, what happens if these companies go out of business? What's the chance of me making sure I get my claim? I guess that's really what anybody really wants to know, is will I get my claim or not? The good news, at least in the long-term care space to date, and it's been around, as I said, it's probably close to 30 years in the format it is today, The claims are paid. They've been paid in New York. Companies, the good news was with them being very large companies like Travelers and CNA, those companies are still there. They just decided not to be continuing to write new business, but they're honoring the claims that are there. Most of these products are issued in the health insurance side of insurance space, and health insurance companies have generally been very well protected in this state. But it has been the case that they will pay claims. I've seen companies do that generally.
It's like AIG
Mhm.
in the 2008-9
Yep.
arena, they were about to go bankrupt. If
Okay.
something were to happen at
Okay.
that time, where it actually happens,
Mhm.
would the state pick it up?
There is a state health program. It will cover policies up to a certain dollar level. But to get back to your AIG point, just to paraphrase again, AIG potentially could have gone out of business. The good news was their insurance company that wasn't even close. Was not even close to going out of business, even with the bad press that the rest of the arena, and that's not an assurance that in the future that will occur, but generally speaking, insurance companies have much stronger reserves than do banks, which is why there wasn't as much destruction there wasn't really any to the insurance industry during the downturn that occurred a few years back. There was a couple other hands. Did we answer your questions?
That
Yes.
doesn't answer the question.
I mean, are we having assurances of the state?
The
or-
state, yes, the state will cover up to a certain dollar level for health insurance claims. That's not an infant one. They will not cover it infinitely, but yes, they have a process for that. Okay. Yes, ma'am.
My question is that I'm right in the middle of the baby boomers,
Okay.
and as you say, we haven't hit the,
Hit the using part, yep.
we're in the purchasing part.
Mhm.
So given what's happening, as you say, with the insurance companies and their ability to pay claims, what's your thought into the next, say, 10 or 15 years of what will happen with the companies?
Okay. Excellent question. To paraphrase the question for those in the back of the room, what could happen to these companies with the possible demand that's coming? Let me give you a little bit of history. One of the advantages of being in this field for a long period of time is to really understand how things have evolved. The reason why pricing and it probably comes even back to Wendy's question, the reason why the pricing has changed dramatically. When insurance first came into the space roughly 30 years ago, what they were doing is they were doing, in essence, best guess. And they were basing it on mortality tables. Morbidity tables, not mortality tables. Mortality tables are a probability that you're going to die. Morbidity tables are the probability that you're going to be ill and traceably ill, so you're going to be out for a while. Morbidity tables they based them on were on disability insurance. Okay, disability insurance is based on someone who's generally actively at work and the chance that they're going to be disabled while they're working. Well, now we come to a total different cohort of people, and that is people who are in a situation where they are probably no longer working, and the probability of them becoming disabled for a long period of time. And that's what long-term care does. So it was a best guess at that point in time. Since then, they've been able to collect a lot of data. There was a second compounding effect. So that's one reason why their pricing was not accurate, which is why many companies pulled out when they started looking at the data and realized there was a difference in the marketplace. The second thing that took place is 30 years ago, I know this will be hard for us to remember, and my son thinks I'm crazy when I say this. Where were interest rates roughly 30 years ago? 10 would be on the low end. We were up at 14. He still doesn't think that's real. It was, right? But my point is, for those who are a little younger, they can't appreciate that. But insurance companies were basing models 30 years ago on prevalent interest. Now, needless to say, they would have toned down the 10% to a lower rate to 7, which sounded very reasonable at the time, and used those morbidity tables to come up with pricing. We know those interest rates did not play out. The good news is today, in terms of looking forward, is we now have 30 years worth of senior morbidity experience. We now know that people are going to live longer because we're looking at today's mortality experience. And we know we're in a very low interest rate environment and have been for many years. So the pricing models that insurance companies are working with today reflect those very low interest rates that we have today as opposed to those very high interest rates and current morbidity tables, which, needless to say, will improve in the future, but they've built that into today's pricing. Is that a guarantee that they'll all stay in forever? No. But will it mean that the pricing models that they're using will be solid enough so that they can pay claims in the future? That's really what's important. And the answer is likely yes, because that's been the case so far. Companies that pulled from selling are still paying claims. I have a policy, myself and my wife, with a company that got out of the business many years ago. I'm very confident they'll pay the claim because they've been around, they're still around doing lots of other things and making money at what they're doing. And if they've done this correctly, which I suspect they will. By the way, very important to recognize, no matter what you're buying, today this pricing, as it has been since inception, is subject to change. Any insurance company can file with the state to have an increase in pricing. And many have. In fact, I will tell you most have. But it's not like health insurance where they're filing every year and asking for increases every year. It's happening every once in a while. And most of that request for price increases are on old policies based on those high interest rate expectations and/or different morbidity expectations than they have today. That's really where a lot of that occurs. So hopefully, did that answer the question?
Yes, you answered my question very well. Thank you very much. I just want to say if I'm making the right inference from that,
Okay.
which is that pricing today we can have more confidence in.
I would agree that today's pricing is more likely to be accurate. One very important point, and Mike touched on it briefly, is that, and I had been predicting this a few years back, is at some point in time, the pricing was going to change from unisex pricing, which we've had since inception, to gender-specific pricing. It is now in the marketplace. Good news for the guys.
Very recently.
Very recently this has occurred. Good news for the guys.
Is it really good news?
Not really good news for the guys. It's just better news for the guys. Let's put it that way. Not so good for the ladies in the audience. Here's why. When we mentioned earlier that you have a 70% chance at 65 of needing long-term care, once again, that's an average. If you're a male, you have a 58% probability. If you're a female, you have a 79% probability of needing care. So you have a really, really big chance of that. And needless to say, insurance companies will reflect it has nothing to do with discrimination. They're looking at what's going to work for them. And by the way, because the average length of stay that Mike touched on earlier is going to be 3.7 years instead of 2.2 years, insurance companies have very much adjusted the pricing. Very much adjusted the pricing. And so much so, and this, you're all sitting down so I can share this with you, the company has started that. You can actually buy a policy on a husband and wife at age 70 that's less expensive than insuring a single woman at the same age. Does that make sense? Well, it makes sense, by the way, so if you're a single female, marry a guy. It's going to save you money. No, I'm kidding. Parts of the reason you have to realize in this space, and it's hard for us to grasp because as a population, we're leading the world in coming up with solutions to what's occurring, and that is that a female has so much a higher probability. And we really know, based so far on experience, that females tend to take care of the guys even before the need is there and actually tend to delay the need. But a female by herself doesn't have a lot of help around generally. And so the probability of needing claim is very high. Yes, Barbara, how are you doing? Interestingly enough, some companies will reflect couples in pricing, some don't. It'll vary. That will be interesting to see how they will evolve that further. But at this point in time, once again, because the data is short, one thing I will tell you about insurance companies, they tend to be slow to respond to things. And by the way, for any woman who bought her long-term care policy 10 years ago, that was a good thing because you now have the pricing based on unisex from forever ago. Today, it's going to be a little more pricey. That's really just the nature of the beast. And it will, one thing I have found in this space is it will continue to evolve because as opposed to life insurance that's been around for 150 plus years, where they have all the data and the claim is very certain, here you are in a space where we're still gathering information and it's changing. And so pricing and things will change as it goes. And I need to say social issues are also changing and that will impact how pricing will work in the future. Yes, way in the back.
So I don't think you've done a good job at helping us identify what the value is, or the best path is. So if I have $5,137 a year to spend, and I have a choice between a long-term care policy and a New York State partnership plan, what's the best value for the consumer?
If it were the choice between a non-partnership policy and a partnership policy, and I'm going to suggest to you what's the best value to the consumer, the answer could be either of those or something else. Really, the best value of the consumer is actually to sit down with your planner and work through your situation. It's the answer to that question. To repeat the question is, what's the best value? That's it. Now, in terms of trying to delineate, generally speaking, a partnership policy is going to work more effectively for you than a non-partnership long-term care policy. But is it the solution? Actually, we had one more piece that Mike was going to cover very briefly, and then we'll come back to answer questions again, and that is there's been so much change in the space. This is probably within the last year to 2 years. We're going to talk on one other twist, and then we'll come back to questions, hopefully wrap it up.
Yes, yeah, to answer the question is, we don't know everyone's situation. Would I answer your question and your question and your question? Could all be different. Not only could it be a partnership policy, but it could be a partnership or a traditional long-term care policy with or to supplement a hybrid life insurance policy. And what I mean by that is, in one of the examples in one of the earlier slides, we showed someone protecting 50% of their assets with a New York State partnership policy with $1,700 a year, 50-year-old male. Now, how are they going to cover the other 50%? I don't know. We already discussed that self-insurance was probably not a good idea since this is going to cost $500,000 in 24 years. One of the options would be to purchase, and it is new to the space, there are a couple carriers in the state of New York that have a hybrid life insurance policy. And what that means, we kind of invented the word, we didn't invent the word hybrid, but to describe this life insurance. What that means is it has a death benefit, and it has either a chronic illness or nursing home or long-term care benefit. The delineation there is subtle, but they define it usually as a chronic illness benefit to cover long-term care. So what this does is it allows you to access a portion, and it depends on the company, the specifics, and of course the age of the insured at the time of claim, again, depending on the company, what that portion is. So I can't give a generality to 50 people, but it'll allow you a portion of the death benefit for the use of a qualified long-term care claim. And now that is actually a payment to you, some of the companies. As we discussed, we had mentioned that earlier. It's an indemnity payment versus a reimbursement with most of the carriers, meaning you could actually have a New York State partnership plan paying for 100% of your care, buy one of these, and still file the claim if that made sense in your financial plan. Again, maybe it does and maybe it doesn't. The individual situation will be different. So this allows you, and we have seen it with a number of clients, to take the costs of premiums they were either planning on spending or are already spending on a life insurance for long-term care, and as long as they would qualify to upgrade or underwrite, depending on the situation, for one of these new policies, you can kind of do triple duty. And the triple duty is, you know you're getting a death benefit. We know the stats of long-term care were staggering, but the stats of dying are 100%. So we know we're getting that. We know we're getting that. We could also access a cash value because these are cash value policies. So if in retirement you say, hey, I want to buy a boat and I put a lot of money into this policy, you could use that as a supplement to a retirement strategy. And then thirdly, you could access some of this death benefit for a qualifying chronic illness claim. So these have become popular. We mentioned on one of the slides, 6 slides back, that there was a little asterisk. There's also hybrid annuity products. Those are not currently, well, as of yesterday when we finalized this presentation, not available in New York. But hybrid life insurance policies are. There are different ways to pay for them. Some of them are paid on the back end, like I mentioned, which means they have no upfront cost in addition to the life insurance cost that would be in there. Some of them have a rider or something of that mechanism that you do pay for on the front end, but then you don't pay for on the back end. So there's multiple different ways depending on the insurance company and what fits your specific situation. Now, of course, since we were invited here by the UB gifting office, these are really great tools for gifting because, as we mentioned at the very beginning, there is an elephant in the room. And the elephant is, if I spend 24 years from now, when I am at claim age for long-term care, $500,000 a year, and I'm in for 3 years, I just spent $1.5 million of my assets to cover myself, just myself, not myself and my spouse, that would be $3 million, to cover a long-term care claim. Now I can't give that $3 million to the University of Buffalo, my kids, or my dogs, or whatever else I wanted to leave it to. These hybrid life insurance policies, we know we're getting the life insurance claim, we have the cash value to access should something come up along the way, and we have some protection that may either supplement, complement another policy, or may be the only way that we choose to protect, depending on our strategy. But this not only allows us to protect our nursing home needs, it also allows us to protect our gifts to our heirs and our gifts to places that we think are very valuable and very important. So I think that that's why these have become increasingly popular. We are seeing a lot of clients look at the life insurance dollars they're already outlaying and say, can I use these dollars more effectively? And it depends, again, generally to the 49 of you or thereabouts, I don't know, but specifically it has worked very effectively for a lot of our clients. And we've seen a lot of growth in this space because of the other things we covered earlier in the slide, which is the staggering and increasing cost of long-term care. And that, if you didn't buy yesterday, it's going to cost more tomorrow. This is one way to kind of hedge that bet, and a lot of people have chosen to supplement with this. So, does that help? Questions? Yes.
In terms of the new credit, does that make sense if your only need is for long-term care, you already have life insurance?
Sure. The question was, if your only need is for long-term care, does it make sense, I'm assuming, to get a hybrid life insurance policy if you already have life insurance? The answer is most likely, but not always. Some older life insurance policies are fantastic, and I wouldn't touch it with a 10-foot pole. New York State has a policy called Regulation 60 that says I have to fill out a lot of paperwork if I go and recommend to you that I replace an old policy. And that's to make sure that you're protected as the consumer, and that I'm not saying, yeah, go replace your old policy with something new because I got this little bell or whistle. That's one thing. Now, in many cases, this is a very effective way to take, especially if it's a cash value policy, the cash value that already exists in that policy, and now we did double duty there, that would be the cash value that's growing, and the death benefit, and now we've added triple duty, the long-term care benefit. So that can be a very effective leveraging tool, but not always the case, and I wouldn't care to guess the percent of cases where that is an effective way of leveraging. But it does work for a lot of ones that we have done, and we have upgraded a lot of our clients or brokers' clients' policies lately. Yes, some questions at the back.
Studies show that it's cheaper and better for the patient to care for the elderly in their home.
Mm-hmm. Yes.
Or will these policies cover that kind of care?
Sure. Question was, for anyone who couldn't hear, studies show it's cheaper and better for the patient to cover home care. Yes. Pretty much most of the policies sold today, including most of these hybrid life insurance policies, will cover qualified nursing care in the home. So as long as the person is accredited and whatnot. There were some older policies sold back at the beginning of the career that did not, and there are still probably a couple somewhere on the market. I can't think of any in New York, but elsewhere there may be. Another question, way in the back.
I missed what on page 14, you have a table comparing partnership plans. I don't understand what that table means or.
Okay, yes, that's the graph. The partnership plan that's comparing, there are two, just to generally outline that, there are two types of New York State partnership plans that can then be priced from there. There's what's called TA, or total asset, and dollar for dollar. The ways that you can purchase a New York State partnership plan is you can say, I want to protect $1 million. And so you can buy $1 million of protection. And what that is Medicaid protection. We talked about the spending rules and how you have to get rid of all your assets from Medicaid. And we talked about how New York State partnership allows you to qualify for Medicaid while having up to 100% of your assets protected. So,
Who designates that? You buy it from the state or?
no, what it is there are certain insurance carriers, and as we mentioned, there are less currently selling. Though if you bought one 5 years ago from a different carrier, it would still be available. You would buy that and you get to choose. So it's kind of a lot of what we talked about, there's a lot of customization. So you do need to talk to a financial advisor to say, does it make sense for me to protect $1 million? Is that all I'm gonna have exposure to? Or does it make sense for me to protect 100%? There,
I understand the concept, I
Yep.
just didn't know that was a choice when you bought long-term care insurance.
oh, yes. That's,
For perfect clarity, you buy it from an insurance company. There are a handful approved. You can go, there's actually a website New York State Partnership has, it's NYSPLTC, New York State Partnership for Long-Term Care.org. And in there, they will have the approved companies. There's about 6 or 7 of them today. I always hedge my bets because they're changing all the time. But that's roughly what it is. And by the way, very importantly, in that site also, they will have who is licensed to sell long-term care partnerships contracts within the geographic area so you can look. And that's a more limited number than usual. So those are important site to be able to take a peek at.
yeah,
Does a hybrid plan have inflation adjustment?
no. And that is a very important delineation, and we might have skipped over it earlier, was the very, very important features of traditional long-term care are that cost of living adjustment or inflation adjustment rider, because as we went on, that is very valuable. Which is why a lot of times what we would do in that case would be, say you had $2 million of life insurance already, maybe we would boost that to 3 or something to try to hedge some of that potential down the road inflation. So because you're really buying a life insurance policy, we can maneuver that custom. Yep, here you go.
And because it's a life insurance policy, it will have full New York State Insurance Department protection then? The hybrid.
Correct. They're bent to the extent, right. And the question keeps coming up is, what does New York State do on insurance policies? To the extent of New York State law, which can change, New York State protects insurance policies. They have rules for life insurance policies, so the hybrid life insurance policy is a true life insurance policy protected by the laws and such there. To answer the other one, long-term care insurance is protected by New York State law to the effects of the health insurance laws and how New York State protects. And New York State is the leader in that front of protection, but not to say that things can't change tomorrow or while we've been standing here. So you look like someone closer, back.
Someone with a Medicaid trust, they put most of their assets into the trust. Are they still a candidate for long-term care insurance?
So the question was, if someone has a Medicaid trust and they put most of their assets in a Medicaid trust, are they still a candidate for long-term care insurance? That would be kind of a crouched question, is that's going to depend on the individual, because you still are going to have to pay for the long-term care insurance, or excuse me, the long-term care. You're going to have to spend down the assets that don't exist in the trust. I mean, you have to live, so you didn't move all of your money to the trust. So do you want to protect those? Maybe they would be a good candidate for a partial protection, to buy a dollar for dollar plan, or to do a hybrid plan to protect their assets that aren't inside the Medicaid trust. But again, it's going to depend on the situation. So, yep, there's one way back, and then.
Going back to the home care issue, and again, I know it varies, for what your needs are, but is there general terminology that we could look for in that coverage that would give maybe the broadest, options for home care?
Sure. The general terminology is going to say something to the effect of home care. Most of the policies, I think everything we covered with a couple outlying exceptions, are covering that home care today. Most traditional long-term care insurance policies are. All partnership policies are to a point. Some are only 50% on the Streamline example, but the total asset one is 100% home care. And then the hybrid, because it's what's called an indemnity, as long as the person is a qualified home care specialist, an indemnity policy pays you, and you pay the home care specialist. So it's not going directly, so that'll be covered as well. But the one thing you would want to look for, and again, to answer more specifically, if you met with an advisor, if you do strip down the partnership to its bare elements, it does allow to only cover 50% of home care today. That we don't see a lot of that in the space, but it does allow for that. There was one, yep.
Yeah, so regarding the coverage for home care or other nursing long-term care, is it only confined within the United States? What if you go accident in Mexico or Canada or any other place, would that cover for legitimate claims?
Sure.
You want to take that?
I'll take that one. The question was, if I go outside the United States, will it cover the claim? You have to be very careful. Depending on how old the policy is, some older policies would cover you outside the United States. Some of them are international. That was the good news. Bad news is most of the contracts being offered today are usually only the United States. Sometimes they will be US and Canada. Generally, it's very hard to find coverage outside, keeping in mind that the level of care here is institutionalized, and in many countries, that's not the case. So it would be very challenging for an insurance company to recognize the ability to pay a claim where they can't substantiate how institutionalized is the care. What's the data based on? And by the way, one thing, if you have, we've mentioned and batted around the terms a little bit, indemnity. An indemnity contract pays the claimant or whomever would be responsible for the claimant the money directly. In that situation, there is the ability to be able to pay whoever you want or do whatever you want with the money as long as you meet the criteria. Many of the hybrid types of policies we talked about are indemnity and therefore would pay the person regardless of whether or not there's an institution providing care. So if you were going to be doing international care, the thing you would want to be looking for would be an indemnity feature in it. And that's very prevalent in the hybrid space. I think there was another question. Yes, sir.
Are there cheaper policies that have longer waiting periods, like a year or 2 years?
You can still find 180s. I think there might be a 365 out there, but they're out there. There are some out there. They're just not that prevalently sold. The reason why is when you're looking at exposures for 140 or 50 up front, most people get a little nervous about that. The pricing difference is not significant. Most of the time when you look at that, you're looking at a few $100 pricing difference. But they are out there. They exist.
Now, your statistics on 70% and 3 years duration, is that for skilled care?
That is for long-term care that's presumed to be care in a facility. So we have not included in that data a lot of the home care situations.
But is it skilled care or?
No, it's custodial. It's any level of custodial skilled, any levels that we've come out in between those. It's in an in-facility need.
All right, and your 120,000 or whatever, is that a skilled, that's skilled?
No, that would be custodial care. Skilled would be slightly higher than that, or significantly higher depending on the level of skill necessary. Question here, yes?
Okay, so I've seen the statistics that say that, 70% of people are going to need long-term care at some point. But I've also seen stats that say that the time period during which you're going to need long-term care is significantly shorter than the times that you're showing. So that oftentimes people don't go into long-term care until they're at the end of their life, and it's like 2 or 3 months, not 2 or 3 years or 4 years. So can you speak to
Yes,
that?
the question was, your statistics say that it's out there at 3-ish years. I'm seeing things that say things are shorter than that. And the catch to averages is their average. It's kind of like the weather. The average temperature today is, but it could be anywhere way above it or way below it. Yes, many people's stays for long-term care are very abbreviated. Often not even getting into the pool of data here because it could be a couple of days and generally that's not going to show up. But if it's a few weeks, what you have to do then is recognize the other end of the average, which is the sad comment, and that is that roughly 10% of people who are in for a year will be in for an average of over 6. And so you get some people who are out for 6 and 8 and 9 and 10 years and take those numbers and average it with the person who's been in for 2 months, and that's how you get that statistic in the middle. That's the catch to that.
So the point here is that the mean is really sensitive to extreme values.
Correct.
And you're reporting the mean.
Thank you. Yes, there is no question that there are extremes. The importance of that is, yes, the probability that you could die after 2 or 3 months of needing long-term care pretty high. But the flip side of that is the probability that you could be out 7 and 8 years is not insignificant. It's statistically significant. It's not a 1 or 2% chance. It's pretty high after you've been in for a little while. But yes, and that's the hardest part of planning for this is you have no way of knowing where you are in that scheme of data and why it's important to at least address this issue to some extent because you don't know where you are on that platform. Another question? Yes, sir.
my understanding that if you're under a partnership plan and you've exhausted your benefits and you're using the Medicaid, you still contribute your income toward your keep. Is that correct?
You would still continue to provide income, correct?
And I would like to know, what do they consider income? Is it from every source, or is it mainly pensions, or what is it?
Income for Medicaid purposes, and the bad news is there's two definitions, one for non-partnership and one for partnership, but I'll give you the general rule. It's pretty much anything that is income, pensions, Social Security, et cetera, but other things like dividend income, interest income, and so on. It will also, for regular Medicaid, apply to actually calculating the value of an asset if it can be used to provide for Medicaid. So for example, if you have a life insurance policy and it has a cash value of $20,000, that will actually be transferred out of asset to be utilized. They can do the same thing with annuities to ask them to be generating income, even though you are not generating income from them. So pretty much they're making everything become income for purposes of calculating.
Strip you of everything.
You're stripping you of everything. The purpose of this is you have, for recognizing the social good that this is supposed to do, is Medicaid was designed initially to provide for people who were unable to provide for themselves. The goal was not to provide for everyone to be the solution to this. And as they've looked at the data over and over again, it's very challenging to find ways to provide for even the majority of the people using Medicaid, which is why, by the way, one thing we didn't cover, and we are very remiss in not covering, the state of New York does one wonderful thing for long-term care insurance and has been doing it for over 20 years and does not communicate it very well. And here we almost did the same thing. I apologize to you. And that is they provide a tax credit of 20% of the premiums for long-term care insurance. Long-term care insurance, not hybrid policy, not life insurance. For long-term care insurance, 20% discount, whatever that premium is. And there isn't a limit on that. So they really see the magnitude of the issue, and they are trying to encourage the population to do something about the magnitude of this issue, and that is more people on Medicaid means we're all going to end up paying more in the long run. So they're encouraging us very heavily to go out and buy policies. And we're talking a credit as, for clarity, a credit is actual dollars. If you owed no money in taxes, they would send you a check if you had a long-term care policy and got the 20% credit. It's not a deduction. We're talking actual real life dollars, which is significant. Yes, ma'am.
So for your partnership program, which goes beyond the 3 or 5 year policy after you've exhausted, there technically could be a problem. So if you said even if you have $1 billion, it's fine. But technically, if my $1 billion can fetch me $100 million a year, it's not for me. So what kind of people with this, whose asset class is within what category, so that people can better judge and perhaps something surpass their future? They can say, okay, this makes sense for me, or I might have too much money in partnership, I'll be losing money. Okay. Can you give us some idea on that?
I'd love to give you general rules, but as you can see from our conversation today, as costs go up over time, it makes it harder to model a solution. And as the rules changes, there's fewer companies and so on. The question that she was asking is, how do we put together rules of thumbs regarding partnership and or any other things? And I'd love to tell you there are some. There aren't. If you have extreme wealth and you're looking at the partnership, recognize that you can still get a 4-year policy with 100% home care and covers a lot of stuff. After which point in time, the income's subject up to the limits of income that they're required to take out of your in your example, your $100 million. They aren't going to take it all. They're only going to take the amount up to the level of care provided. So after the policy is exhausted, yes, that's not the solution. There'd be better solutions for you in that example than taking the partnership for the 4 years. You might want to do a hybrid afterwards to cover another portion if you needed that. And by the way, also to give the life insurance to beneficiaries, be they the university or your kids. Well trained, aren't we? Yes?
Two questions, a simple one first. I'm assuming, and I'd just like the confirmation on this, if we're deciding between this skilled facility, this facility, home care, the choice is strictly up to the individual, the insurance policy. Insurance people have nothing to say about where you choose to go.
Okay. The question was, if I am needing care, does the insurance company influence where it is that I have care? Generally, and I'll use that word again, generally the insurance company's not in the way. If you've got a decent contract in New York today, I mentioned that care management feature a little early. They'll help you find the right places to go, but you don't have to take their advice. It's a tool to help people because most people don't experience, when you're 12, you haven't experienced this. When you're 40, you haven't experienced this. When you're 80, you haven't experienced this. This is your first time for most people, unless their parent actually just experienced it recently. Because this has changed. I can tell you that the process of providing care and the levels of care have changed dramatically over the last 25, 30 years. Care management is there as advice. You can not take it if you don't want. If you say that I heard what you said, but I want to go over here, that's your right. As long as it's a licensed facility, they'll pay the claim. That's for home care versus institution. Keep in mind, it's the insurance companies recognize home care also is the best thing, going back to the earlier point. It's the least expensive, it's the least stressful on the family. And one thing very important, we've talked about a lot of data and numbers. Really, when it comes to long-term care, it's really about personal dignity, personal independence, and it's really about an individual's ability to do what they want to do. And most people want to stay home as long as they can. And anything that anybody can do to help that is a good thing, regardless of what the insurance companies do. Well, interestingly, yes, she says that only insurance companies care about the bottom line. And the answer is yes, they do. But they also, the good news when it comes to home care is home care helps keep the bottom line for them. So they're actually on our side on that one. It doesn't happen all that often, but for that one, they're on our side. Yes, there was one. Yes, I'm sorry.
You mentioned earlier that it would be probably less expensive to buy a husband-wife policy versus, say, a single woman policy. Let's say we buy a husband-wife policy, one of us goes into long-term care or doesn't, passes away.
Okay.
How does that impact the policy? Do they rewrite it as a single female
Okay.
P goes, single male P goes?
Question, paraphrase the question, if you have policies of husband and wife, one of them passes away, does the pricing change for the surviving spouse? The answer is generally no. Pricing is usually what it is, unless for whatever reason the insurance company's filing for everyone to get a price increase, but the event of the passing of a spouse will not change the other contract because they are usually two separate policies, and the one policy will continue to have the premium that it had prior to the death. That's the way most of them.
Straight one charge husband-wife policy, they're still considered separate.
They're two separate contracts, and the one, when the one is gone, the other will still continue.
Not a joint contract.
Correct. I'm very rare on the joint policies. I know we're running real close on time. I want to respect everybody's. We're happy to stick around and answer any questions that anyone has, but I'd kind of like to put a wrap on this because I'm getting the signs here. So I'll take one last one.
Just out of rule, is it general to the long-term policies? Say if you're like at 55, you pay a certain price and it goes up at age 60 and age 65. Is there a general rule of thumb that we're usually 10 to 15?
Okay, the question was, is there an increasing price situation that tends to be one way or another? I think Mike answered that question earlier. The best time to buy long-term care insurance was yesterday. It's least expensive the earliest you do it, no matter how you do the math on it. The sooner you do it, the less expensive it is. When you start getting into your latter 60s, you don't want to see how fast the prices are going up. So the sooner, the better. General rule has been that way. 30 years ago, it was still that way. Buy young. I bought very young, as I did with my wife, when I looked at the math on it. I want to thank you very much for being a very attentive audience, and I appreciate Wendy and Neil for inviting us, and we'll stick around if anybody has any questions. Thank you very much.
Before you go, I just ask you to give me 3 more minutes. You can want 7 o'clock. First, let's thank Jim and Michael for a wonderful job.